Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Anhui Conch Cement Company Limited annual report. Anhui Conch Cement Company Limited is a diversified conglomerate with a wide range of businesses and services. At its core, the company manufactures and sells clinker and cement products, both domestically and internationally. In addition to this primary business, Anhui Conch also provides various supporting services such as construction and installation, logistics, financial support, road freight transport, and mining. The company's product portfolio is equally diverse, encompassing cement packaging products, concrete products, refractory materials, construction materials, non-metallic mineral products, new materials, chemical fibers, aggregates, and construction stones. Anhui Conch also engages in the development and sale of profile and related products, as well as the export of clinker and cement. Beyond its core businesses, Anhui Conch has expanded into various other sectors, including infrastructure development, energy generation, and waste management. The company constructs industrial and civil buildings, highways, and is involved in investment and trading, machinery installation and maintenance, product testing and environmental inspection, technical services, and research and development. In recent years, Anhui Conch has also ventured into renewable energy, with a focus on photovoltaic and wind power generation, as well as energy storage system development. The company's commitment to innovation is evident in its research and experimental development of automation machinery and other new technologies. With its extensive range of businesses and services, Anhui Conch Cement Company Limited has established itself as a major player in the Chinese economy. Anhui Conch Cement Company Limited market capitalization of 119 billion is significantly larger than the average industry peer of roughly 3 billion. This shows that Anhui Conch Cement Company Limited holds a significant advantage in their industry. Anhui Conch Cement Company Limited trades at a higher price-to-earnings ratio of 12 times and a higher price-to-book ratio of 0.5 times relative within the industry. This shows that investors are pessimistic in the industry in general, and we should dive deeper on the reason. Additionally, the stock appears attractively priced, even though it is trading at a higher price to value than it appears. We will need to evaluate if the business earnings is sustainable and if the assets are valuated rationally. Overall, we need to identify if this makes a good investment on the long term, or is it going to be an extended period of low valuation or a value trap. The balance sheet appears very conservative, with liabilities representing only 20% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The company have a dividend yield of 4.96%. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. The primary drivers of revenue growth or decline can be identified from various key points extracted from the provided summary. On the revenue growth side, several companies within the conglomerate have experienced significant increases in production and sales of concrete products, such as Zhonglian Zhangjiao Construction with a 100% increase, Madai New Material with a 65% increase, and Huisheng Road Engineering also with a 65% increase. Additionally, other companies like Wuhu Green Construction, Ying Shengd, and Ying Tongd have seen growth in their respective areas of operation. Furthermore, the conglomerate's expansion into new markets through its subsidiaries has contributed to revenue growth. For instance, Indonesia South Conch, with a 71.25% ownership stake, manufactures and sells clinker and cement products. The company's diversification efforts, such as processing and sales of construction stones by Wuhu Conch Green Construction and Man Mountain Conch Green Construction, have also contributed to revenue growth. On the other hand, there are limited instances where revenue decline is explicitly mentioned or inferred from the provided extract. One notable instance is Prosperity Conch Cement Co., Limited. S profit for the year decline of -19% in 2025 compared to 2024. However, no primary drivers of revenue decline were mentioned in most sections. The conglomerate's exposure to interest rate fluctuations and currency risk may also impact its revenue growth or decline, but these factors are not directly linked to specific companies' performance. Net income decline and profit margin shifts. The company's net income experienced a decline of 6.9% year-over-year, resulting in a decrease of Rm 125,101,000. This downward trend continued with another drop of Rm 86,977,000. The exact reason for this decline is not explicitly stated. In contrast to the net income decline, certain product lines saw an increase in gross profit margins. Self-produced 42.5 grade cement and clinker witnessed significant gains of plus 2.88% and plus 11.39%, respectively. Additionally, self-produced 32.5 grade cement experienced a notable rise of plus 6.28%. However, the aggregates and manufactured sand segment suffered a decrease in gross profit margin, dropping to 40.13%. The industry-wide trend of narrowing profit margins is attributed to weakening demand and intensified market competition. This shift highlights the challenges faced by the company in maintaining its profitability amidst changing market conditions. The company is generating positive operating cash flow. This can be seen in the various pages that report net cash generated from operating activities, which consistently show an increase or a positive value for both 2025 and 2024. On page 12, the net cash flow generated from operating activities is reported to be RMB 16,643,908 in 2025 and RMB 18,476,253 in 2024. Similarly, on page 14, the quarterly breakdown of net cash flow generated from operating activities shows positive values for all 4 quarters in both years. The depreciation and amortization are also reported to be positive on page 241, indicating that the company is generating sufficient cash from its operations to cover these expenses. Furthermore, the operating cash flow is consistently reported to be positive on pages 339, 340, and 345, with values ranging from RMB 51,334 to RMB 62,953. The loans and receivables also show an increase in both years, indicating that the company's operations are generating sufficient cash to cover its financial obligations. Overall, these reports suggest that the company is generating positive operating cash flow, which is a key indicator of its financial health and stability. The company's debt level has undergone significant changes over the years. Initially, there was a decrease in total debt by -3.64% from the previous year, and a reduction of RMB 3,943 million. However, this trend is not consistent, as some reports show an increase in debt levels. For instance, between 2024 and 2025, the total debt increased by 101.4%. Additionally, there was a decrease in debt level from RMB 51,216,510 in 2024 to RMB 42,558,174 in 2025. In terms of interest expenses, there is evidence of significant decreases. Interest expenses have decreased significantly by 22.08% and 20.1% in some reports. The interest expense for 2025 was RMB 742,540 compared to RMB 854,483 in 2024. Furthermore, the finance costs for 2025 were RMB 650,683, which is lower than the RMB 778,705 recorded in 2024. Overall, it appears that the company's debt level has fluctuated, while interest expenses have decreased significantly over the years. The financial performance of various segments and regions within a company has been analyzed. The Eastern China region stood out as one of the top performers, with significant revenue from external customers and reportable segment revenue reaching $52 million in its best year. In contrast, Western China struggled, recording the lowest reportable segment profit among all regions at RMB 1.11 billion. Overseas operations also underperformed, with a low reportable segment profit of RMB 710 million and the lowest reportable segment revenue at $5.5 million. Central China's performance was mixed, with high sales and trading of clinker and cement products, but lower reportable segment revenue compared to other regions. The performance of southern China is not explicitly stated in the analysis. Management is optimistic about the company's outlook for 2026, citing government support as a key factor. To capitalize on this momentum, management plans to deepen market cultivation and implement lean management practices to improve quality and efficiency. Key areas of focus include formulating precise business strategies, optimizing costs such as fuel and power, and reducing carbon emissions through efficiency improvements and the adoption of alternative fuels. The company is also committed to green development and low-carbon transformation, accelerating research and development of green technologies. In addition to these initiatives, management is investing in new projects to expand the company's business scope and increase market share through partnerships with other companies. This strategic approach aims to drive growth and competitiveness while minimizing environmental impact. The company has a history of paying dividends to its shareholders. In fact, it has been consistent with its dividend payments in recent years. For 2024, the final dividend was approved and paid out at RMB 0.96 per share, totaling RMB 5,065,978. This year, the proposed final dividend for 2025 is set at RMB 0.61 per share, amounting to RMB 3,219,007. These figures demonstrate the company's commitment to rewarding its shareholders through regular dividend payments. Concerns about the company's supply chain and inventory management have been raised. The top suppliers for the trading business have a higher total purchase amount than sales amount, indicating potential difficulties in selling products or managing inventory levels. This could lead to supply chain disruption if not addressed. Furthermore, the company's ownership of Tianjin Anhui Supply Chain Technology and Zhejiang Trading Green Quarry raises concerns about potential supply chain risks. Additionally, an analysis of inventory levels shows that while overall inventory decreased, raw materials and spare parts inventories decreased significantly, while finished goods inventory decreased by a smaller amount. This suggests that there may be a buildup of finished goods, which could lead to further issues if not managed properly. That concludes the financial summary for Anhui Conch Cement Company Limited. Feel free to comment below, and I will be happy to answer them when possible.